Okay. Previously, we have mentioned that there are two types of dividends that companies can give out to its shareholders. Firstly is the cash dividend, and we have shown the example for cash dividend. Secondly is the share dividend. The company may give out dividend to its shareholders by giving them extra shares. So for example, if I have 1,000 units of shares and in a certain company, and the company decides to give out dividend in terms of shares, then my share in the company will increase. I started off with having 1,000 shares, but I might receive another 100 shares, so now I have 1,100 shares in the company. So in essence, I have more stake in the company when the company issued share dividends. So why do companies issue share dividends? Firstly is to satisfy shareholders' dividend expectation without spending cash. So because shareholders, they are expecting dividend every year, for example, but if the company decides to keep its cash, then they have the option of giving out share dividend instead of giving out the cash. And then they might want to increase the marketability of the corporation's shares, and they might want to emphasize a portion of shareholders' equity has been permanently invested in the business. So if they give out cash, then they have less money to run the business. But in order for them to retain that money, but still to satisfy the shareholders' dividend expectation, then they may give out share dividends, but practically they are not giving out any cash which they could use for running the business. So share dividends is recorded at fair market value. Let's see an example here. Mi Berhad declares 10% share dividend on 50,000 shares. The shares was issued at 10 ringgit per share. The current fair market value of its share is 15 ringgit per share. Record the entry on the declaration date. Okay. So the company declares share dividend. So the expense will be share dividends. We debit share dividend by 75,000. How do we get 75,000? It is the percentage share dividend. Okay, so 10% share dividend rate times the number of shares and times the market value of the share. Although the share was originally issued at 10 ringgit, but currently the market price of the share is 15 ringgit. Therefore, the dividend is actually 10% times 50,000 times the fair value of the share, which is 15 ringgit. So the total is 75,000. So we need to debit share dividends by 75,000, and we need to credit equity share dividends distributable. So this account will be shown under the paid up capital. This is called equity share dividends distributable. It's part of the paid up capital. So in the balance sheet, we will show that there are 50,000 units of equity shares as originally here, but then we also have the dividend that we just recently declared. So that will be another account here, equity share dividends distributable 75,000. So in total we have a paid up capital of 575,000. When it is declared, but the certificate for the shares has not yet been issued to the shareholders. When the certificate has been given, so in terms of legally the dividend shares has been issued to the shareholders, then the journal entry that needs to be done is that we need to debit the equity share dividends distributable, and we add back to the equity shares 50,000. So at the end of the period, we will see that after the dividend has been distributed, it will be 575,000 of equity shares. Before the dividend was distributed, it was 500,000 equity shares and 300,000 of retained earnings.